So before starting our the today topic, that is the Ministerial Decision 173, let's take the recap of the our last session where we left on the transitional relief. So actually, our today topic is the part of the same or the continuity of the same, because this is the Ministerial Decision come up later on with the from the taxation. So let's understand the quick recap of the transitional relief, and then we're gonna come here. So what are the additional point and the new regulation changes? So in terms of the transitional relief, what is the? This is one of the government given the relief. This is one of the government given the relief. Means the before taxation, before UAE Corporate Tax, before UAE Corporate Tax, if on the property. Okay, so that we have the three category over here: the immovable property, financial asset, intangible asset, and the financial asset. These are the three category. That is the asset will be considered under transitional rules as a qualifying asset. So one of that is the immovable property. So this is the our topic, the immovable property. On that we're gonna learn today the transitional relief. After that, what are the ministerial decision or the tax depreciation. This is not only the learning. We will do one practical example also in the Excel. I made one template. I'll share with you guys also. Once we reach on that, so we'll come on that. So transitional rules on immovable property. So immovable property, what is that immovable property? The property should be on, must use on the cost model. Property must be purchased before first tax period and expected to sell in the first tax period or later on. So this is the prerequisite, but we are saying in a transitional rule for immovable property, it should be on the cost model. When we say the cost model, so how about what is the some property even we purchased before UAE Corporate Tax effective date of, let's say, the 1st January 2024, as most of the company tax period starting from the Jan to December. So it may differ, but we are assuming that Jan 24 is the first tax period and the property is purchased before that. So now the here the UAE authorities given some relief, considering that these are the material value, big value item. Each business have the impact on that. So normally we know in the UAE market the property value maybe 10 million for any business. Or we can say the 5 million still is the material. If we can say 2 million still is the material. So they purchase the property before first tax period, maybe 2020. Okay. And if they are using the cost model that we already discussed over here, so is getting advantage over here. So, but there is some property, maybe not at cost model, at fair value, at market value. Earlier we said, okay, the market value, fair value property will not be considered while the transitional rule we're gonna apply. So this is available only for the cost model properties followed. So now we're gonna talk about the fair value. What is the second leg we have over here? So how it's gonna impact. So let me go through quick overview. First, we have to make the election. The election, we are saying the qualifying immovable property. We are mentioning that, or we are emphasizing that. So these immovable property are the assets of the organization. Normally, what is the property definition? Let's say that they have the warehouse. Let's say they have some building, maybe the towers they given on the rental for earning the rent. Okay. So, maybe they have offices. They have the office and they earning rent on from there. So these are the some of the examples. So first we are saying we want to opt or no. So we select that yes, we would like to have the qualifying work property. But here was the limitation was the cost model. We can add only the properties that on the cost model. So all the cost model property are already considered over here that whoever owned previously will then own previous prior to the first tax period is immovable period and the gain on the immovable. So anyhow, now the second important part, the transitional release, we learned in very detailed the previous. So now let's come on the today topic and the today extension of the existing topic. So this we already covered. This we already covered. So now this is the our if the property at fair value. Earlier we left this point. Now we are looking Ministerial Decision 173. What is the option given for this, or the relief is given to such properties, right? This was the just reconnection with the previous topic, the quick recap. We took almost 9-10 minutes for the quick recap. So again, our point is that we have the elections. The second is the unrealized gain is the same. Transitional relief, if we go one step before, so we opted for the election. Election, we said we will go for the realization basis. Let me see if there is a realization basis. Yes, I'll just give the recap of the assets. So this is the another point, realized or unrealized gain on assets. So what is the important? The second part, election is made. Election is made. So which election is made? If we made election on realization basis, So if we made the realization basis, then there will be a two impact under the current scenario. Now I'm gonna share the our learning will be a very practical aspect, and most of the organization is applicable on that. And as a result of this learning, you might can defer your some of the tax instead of paying in the current year, you may take in the future. Sometime relief are deferral nature that give us the deferred tax asset, and sometimes it's the permanent nature. So we will learn that part also, which relief is a deferral and which is. So now from here onward, we're gonna start our topic of the Ministerial Decision 173, investment on properties. Investment on properties, so we have to learn that. I'm just switching the presentations. So today our session number 11, it is June 7, part 25 on the tax depreciation. The word tax depreciation is our key objective today for learning. Tax depreciation is the tax depreciation. And the Ministerial Decision 173 is give us this opportunity to calculate the tax depreciation and apply on our industry, our organization, our client, or the UE market. So we can say, okay, in the UE market, so Ministerial Decision 173 given us the opportunity where we can apply the depreciation. Now the second question is coming, is this mandatory? Is this mandatory? Answer is that it may opt and may not opt, and may not opt. You can apply and you cannot apply. But maybe some of from us they'll say, okay, no needs to go in this learning and apply this, complicate the things. Just go simple, don't apply that. But the point is not that. Point is that what is the advantage if we gonna apply and we can take? What is the advantage we can take while applying this Ministerial Decision 170? This will be the, I believe, the first of our question and first of our learning. So transitional relief, we already understand this is the extension of the transitional relief as the outcome. So Ministerial Decision 173 and is particularly apply on the investment properties. Here another, what is investment property? Mostly businesses, they have the PP, they have the non-current asset. Non-current asset. So what is the two? First category will be property, plant and equipment. This is the, because the every business have PPE. But some business they have the investment property also. What is investment property? Because they have extra fund from their working capital, so they invested in the real estate and they have some let's say the buildings and they getting rent from them, rental income. Of course, the most of businesses, this is not their primary business. Investment property is not their primary business. Maybe they are doing primary business trading and they have the funds, so they invested in the real estate. And this is the allow in most of the companies. It's not one thing is very important. What we're gonna discuss, what we're gonna learn, this is not the real estate business. The primary activity is not a real estate. The SIGA is not a real estate. Primary business activity not real estate. Why I'm highlighting this? Because if your primary activity is real estate, then the accounting standard and the definition and the categorization of that property may differ. Why? Because that then maybe you have the if you are as a developer in the UE market, then you have the buildings and you keep for them as a sale. This is not your investment property. This is your inventory. For them will be inventory, but the other business who held and who are earning the rental, for them is the investment because they are not core. Again, there is another point. Some real estate, they having a lot of properties. A lot of properties in primary they are a rental business. They are rental business. but they are not buying and selling the real estate. Second difference. Again, if we should know or we should categorize, it should not be the part of inventory. Okay, so the ministerial decision on 173 on particularly investment properties, then the depreciation. Particularly investment property depreciation, our whole perspective is here. So other point, our topic, our agenda is this today. So let's see here, you might go on the Google and search the Ministerial Decision 173 and you can get this decision and download. I can share the link also. If you require, just text me. Okay, so this is released in July 25. Okay, released by Ministerial Decision depreciation adjustment for investment properties. The first point. Second is the held at fair value. Again, I'm going to refresh. Okay, we understand under transitional relief, transitional rules, cost model. If the property cost model, we can apply, but if at fair value, we cannot apply. So now the fair value have Ministerial Decision 173, right? Because here under cost model, depreciation is already part of the profit and loss. Understand the difference? Under cost model, we already charging the depreciation to P&L end. When we come to fair value, on the fair value, is their accounting standard allow you to charge depreciation? Accounting standard or accounting treatment, just confirm, is depreciation charged to the profit and loss or no? If we go here, accounting standard under fair value is not allowing us to charge the depreciation, but Ministerial Decision 173 text is saying charge tax depreciation is not in your accounting books, but while filing city return, you may charge this subject you are meeting the condition. You understand this point? What we are trying to understand here, as a quick refresher or comment. Yes, would you please make comment and chat? To understand this perspective or this topic that we're going to learn today and why we are learning today, and what is the role of the tax depreciation and what we are doing before in accounting and why we are investing now. And this. Okay, let's continue the topic. Here we understand why we are looking for the tax depreciation. So let's understand land and building still confused. So let's see. Now we're gonna just take the overview and understand which property are coming. The same land and building, okay, held for sale, Because this, as I earlier mentioned, different accounting standard is go for different treatment. Held for sale ordinary business, it will be real estate business, it will be your inventory. Like you are a real estate company, okay? But we are saying, no, we are not real estate company. Then if you have any asset, it may be the IFRS 5 non-current asset held for sale. Okay. So now the second test, because these are the point when you gonna second point is held for use. Owner occupied or unoccupied of the businesses. Okay. This is, we said, the PP, property, plant and equipment. So this is the second category is also the excluded. Here is the inventory. Here is the property, plant, equipment. What is that? Office. If you buy the office property and you are using as your own office, you run your business from that building, from that office. So this is your PP. But on the other side, if you have the, let's say, the two building, one is your office and the second you put on rental. So held for the rental to others, okay, plus capital appreciation. Of course, if you buy the property, it might go up and might go down based on the market factor, inflation factors. Okay. So now we are saying, okay, this is the investment. So if these units are treated as per the investment property, IS 40. Lands held with no determined usage, IS 40. Okay, if we did not classify, then it's also come under IS 40. So we are not going further other standard, but just as the perspective held under construction, if any property under construction for other use, for others, property like you are as a contractors, got the contract to make a warehouse for your client, for your customer, then they are saying that the construction contract, it will be treated as per IFRS 15. Is that property that you are building is for own use, it will be IS 16. If your intent or the objective is for rental, then investment property. So again, the property under construction, also what is the objective of that property we are building, that also matters. That also come under the Ministerial Decision 173. Okay, the accounting model in different IFRS overview, we just before starting that, we already look into that. The IS 16 property, plant or equipment, it might come on the cost model, it might come on the revaluation model. Similar way, investment property also come on the cost model, come on the fair value. If the fair value is already treated under the transitional rule, okay. So if under under cost model is already treated under if the cost model is already treated under transitional rules, so now this fair value, the fair value is not treated or not considered under the transitional rule. So this is the leg now we are focusing on that. So on the fair value, no depreciation charge under fair value model, no impairment losses under the fair value model, right? So now tax saying, okay, as the accounting, you are not charging the depreciation. So, but because the accounting standard doesn't allow, they're saying, okay, as per tax, we allow you to charge depreciation. Means you can add another expense. Normally, what is the depreciation? Let's say the property is a 1,000. The use of life is a 10. So per year depreciation is a 10, 100, 100. Right? So if we charge the depreciation in profit and loss, we will do minus 100, which means our taxable income will be decreased. As per accounting, no depreciation, but law is saying you can charge, so we are minusing another 100, and as the outcome, just take the 100 multiply 9%, so Almost 9 is the tax saving in the current year. Now the second part, this saving or this the amount that we not paying, this is the permanent or the temporary. This is the temporary. Okay, but still it's good you are not paying. You will pay in future whenever the asset is sold. Okay, this we also understand in the previous, the same quick recap. Now, the Ministerial Decision 173, particularly specifically investment property, they're defining investment property. The second is saying is defined IAS 40. Okay, which property that defined by IAS 40 as the investment property, and next is the measured at fair value. Measured at fair value. So keep note down the key point that I'm highlighting. So because this is the important understanding. When we look for the Ministerial Decision 173, the first we have to see, okay, as per the accounting standard, okay, the first point is this: as per accounting standard, which properties are classified as a investment property, right? The accounting standard, we looking for investment property. Then next we will say under investment property, the measurement rule, the valuation rule, recording rule. The third is the measurement rule. What is the measurement rule? So we have to see the fourth point, the fair value, not the cost model, right? So the next we are learning, if we are properties are fair value in the financial statement, these are the 4 points we are initially assessing. So normally, if you know the assessment, commonly in your organization or market or in your client, you might also do the assessment. What is called the tax assessment. Okay. So these 4 points are the 4 bullet points. What we are, I'm sharing with you guys. This is the part of the assessment. I'm not saying this is a 100%, but one of the element or one of the area or one of the criteria of the assessment. So we normally in the audit, we are preparing the checklist, right? For each area, like the checklist for the account receivables, account payables, sale invoices, purchase invoices. Okay, so then we are giving to our team, okay, but go and check all this transaction on sample basis. Okay, what we are doing the assessment. Transaction are recorded, are authorized, or all the accounting rules and regulation are applied over there. The same way, when we have the any entity or any customers and any operation, so any LLC company, so then you have to split. Okay, so this entity, which area or which taxation rules are applicable? How you going to start? So you have to get the their financial statement, okay, and financial statement along plus the other information wherever applicable, because normally financial statement may not cover all the points. So then you will prepare, okay, okay, in their balance sheet is shown investment property. Good. So then we will say, okay, this investment property is already treated. The question, the investment property. Now the next question we will raise, okay, they have IAS 40 is applied. Okay, good, is applied. Then next, so which measurement will say, okay, the fair value, okay, it's good. If we are saying no, IAS 40 is there, but it's on the cost, so then we will say, okay, no, it will go towards transitional rules. Okay, so that if it's a fair value, then we will go, okay. So now what is the next ministerial decision is applicable over here? So next we have to see, okay, is there any depreciation previously charged on that. Of course, if they followed correctly the IS 40 and treatment, there is no depreciation. So you have the deduction as per this. So now the decision on benefit, decision only benefit taxable person. What does this mean? This means this ministerial decision, everybody may not get the benefit from it. In this decision or tax benefit, everybody may not get the benefit. So then we'll look into that. Decision only benefit taxable person that prepares financial statement on accrual. The first one, financial statement prepared on accrual. And the second, elected on realization basis for gain and losses. The second important factor, we have to look into that, which election they made. Which election they made. Election means we, in the first tax return, we have to make the election. That election also we covered. So that election we have the option for the realization basis or non-realization basis. We are saying, okay, if you have the other point already that we checked, in addition that we have accrual basis, then we have to see they opt for the election, and opted for the election means the realization basis. Okay, this is the realization basis, the gains under Article 23 of the city law. The feature and mechanism is the same thing that we again, this is the up to here still part of assessment. If we done the assessment, then we know, okay, this is the additional area is applicable. But up to here, we don't know how to proceed towards the city computation, towards the corporate tax computation. So practically, and the people are not familiar with this exercise. They're saying, okay, we want to city return file. Okay. We have only this audited financial statement, rely on this and file the city return. At the outcome, there is a possibility return may not filed correctly. Why? Because the proper assessment is not done. Maybe the information in audited financial statement are not 100% available, or the disclosure is not appropriate, or the classification is not appropriate. So this is the reason mostly the big corporate, they are separately engaging the tax consultant. Even these big corporate, the tax consultant is not the first person. Their in-house tax team, they already done the exercise. But still they are safe side, they are engaging the tax consultant also, because the tax matters are not very simple. They're saying, okay, that's good enough, our team is done, but still let's take the second opinion, let's engage the consultant. If any other matter or point is overlooked, or the tax consultant can add value. Why they are so careful and so caring in regarding of the tax matters? Because it's have the huge impact on the tax liability and its long term. So each decision it will cost to the company. Okay, so now the next we learned so far up to here, and now the next we are saying how to apply. Up to here, the assessment. Now the application. The application, they're saying, the minister is saying on accrual basis, good. Applying realization basis, good. Now we have to calculate the tax depreciation lower of 4% original cost, and the word is or. 4% original cost or tax return down value for each 12-month period. So we need to calculate the original cost 4%, and then we have to compare with the tax return down value. So which one is lower, that we will deduct. So now this point is also maybe many people are already familiar with that, or they are digesting with that. But sometimes it's come the complication also, challenging also to understand what they are saying. Let's say the property value is at 10 million. The cost price purchase in 2020. So in 2025, okay, the market value 2025 is 15 million. Same property, the cost is the 10 million, right? Cost is a 10 million and the market value is 2025. So now the 2025, this is the market value. So the first point is referring over here. So let's say 4%. Okay. So now the tax written down value, if assuming that the first tax period, is starting from 1st Jan 2025 as per the regulation, right? So how we gonna calculate? So we'll say, okay, so as of now, the first tax period value is this. We might have this 4 years, 5 years. Okay. But what we are looking for, lower of. We will calculate the 10 million. So what is the missing over here? The life. So let's add the life, or the asset is 10 years. Life of the asset is 10 years. So before first tax period, how many years? 5 years, right? From 1st Jan 2020 till the 1st Jan 2025, the 5 year. So if we divide by 10 million, if we are dividing the 10 million with per year 1 million depreciation. 1 million depreciation. Then up to 25 is 5 years. So means 5 million depreciation. If we are just calculating outside the books, because the currently asset at fair value, right? Market value, fair value. So we are just looking into that. Okay. Considering the same original cost, because if we follow the cost model, so we already maybe depreciate for the 5 years, right? So then the balance amount is the 5 million. So let's assume at this the tax written down value is a 5 million versus the 4% of the original cost. How much? Anybody would like to take the 4%? If we consider here the 10 years, almost the 10%, okay, that we can set is the 1 million, right? So this will be the 400K. So the 400 is lower or the 5 million is lower? Practically, the 4% of the cost will be lower, and that we can deduct. So anyhow, we have the detailed example. We will come on that example and understand on that also. So just 1 minute. Okay, so now let's okay, this slide is covered. So now we're gonna move to the next slide. So, question so far up to here? Dear, any questions so far up to here? Any question? Yes, Adnan, Mohammed Ifrahim, Mohammed Amir. Any questions so far? Okay, let's continue with our topic. Mr. Amir, Mr. Ifrahim, Adnan. Let's continue. We have to come up with on the example. So let's. We already understand this part, the 4% depreciation. Let me see if I can. Okay. So this part we covered. So now the next, we have to summarize the further key bullet point. What is the key bullet point of the Ministerial Decision 173? Action must cover election must cover all investment property measured at fair value. Measured at fair value. Under transitional rule, they're saying like if we have the categorize the fair value, then we have to cover all properties. Like if we have 10 property, it all will be covered for the tax depreciation. If we opt for that, okay, the election cannot be revoked. Saying, okay, even if you made this election, then you cannot go back. You have to continue in the same way. The election must be made in the tax return. Election must be paid in the tax return. That we also understand and we learned before in the previous session, particularly which election we are talking about. The first tax period to which Ministerial Decision No is already held. The first tax period to which apply if investment property is already held. So earlier we already understand it start from the 1st January 2025. But if the property held in 2026, then of course this is his first tax period, right? Afterward, if somebody purchased on 2027, so his first tax period for that property point of view, for that election point of view, for ministerial decision, it will be that. But before that, other condition also he have to look into that. The first tax period thereafter. This is the same thing we understand over here. First tax period in which Article 21 cease to apply. So again, if the business already opting SBR, okay, maybe in 24, then he opt for 2025, then he opt in 2026. So means for this company, even election, the property is there, but he already opting for SBR, then he can opt in 2027 after once the SBR relief is no more, right? So this is the first tax period for the subject election. CSBR is in terms of the filing, maybe is very easy, but what are the advantage or disadvantage towards the company? That is very important. That we have to focus. What are the advantage and disadvantage? We learned before also, and we, of course, we will cover separately under SBR. Today, our topic is not the SBR. Failure to elect within the prescribed timeline result forfeiture of right to apply the regime. Again, this is the importance we are highlighting since beginning. The depreciation deduction, again, the annually is 4%, then the 4% of which value original cost or tax return on value, that also we understand. Ownership is less than or more than 12 months, this 4% for 12 months. So it will be pro rata if ownership period is less than 12 months, is 10 months, less than 12 months, or if the ownership is a 14 months, depends upon the first tax period or any change in the tax period. So we have to prorate based on the actual duration of the financial statement that we are working on that. Deduction start from the first tax period in the election and continue until tax return down value reach to the nil, right? Tax return down value will reach to the nil. What is that? That is the cost. We'll keep continuing. So as we take the example earlier, if asset is purchased 5 years before first tax period and the total life is the 10 years, total life is 10 years, let's assume that. So 5 years after tax period, he will apply this rules. Okay, maybe after 5 years, the value or the life of the asset may be reassessed and the recalculation will be there, or asset is sold. But in principally, we are saying the next 5 year we will minus this, minus this, minus this. What is that? This is a tax depreciation. Tax depreciation accounting doesn't allow. Maybe in your financial statement is not recorded, but here is recorded. So this is the same concept, original costs. We already understand. Even let's, our way of learning. Before diving into that, we understand the key fundamental key principles. So it's easy while we are reaching to these points. So the first we have to determination, original cost from the purchase contract, then the opening value at the first tax period. So we have to do backward calculation and come and tax return on value.
Recording has been resumed.
Welcome back. We're gonna resume the same topic. So before that, a quick reconfirmation. I'm audible. I'm audible. Yes. Okay. So let's. My screen is here visible. Yeah, visible. Let's continue the same topic and see. See, these examples you might go and search from the FTA guide or FTA. Mostly the guide public clarification, they are already given over there. This is the same way taken from there. So UAE company on a hotel building, UAE company, which is recorded as an investment property. So first the scenario we are understanding, this is not the hotel, this is they're saying a UAE company on a hotel building. They're not running the hotel business. The property was acquired, the property is purchased 2020, 1st January at 1 million. Property is held for 5 full calendar year prior to the first tax period. Okay, this is before first tax period. To the Ministerial Decision 170, resulting in a deemed depreciation of 2 before first depreciation. Okay, how? The 4% of 1 million, then multiply 5 years. So which means the 4% of the 1 million is coming how much? 40,000. So multiply by 5, so it will become 200,000. This is the depreciation before first tax period. How this depreciation? If we are following the cost model, assuming that if we have the cost model, so what is the depreciation? As if understanding, although in the books is not the cost model, we are currently following the fair value, right? That's why we come up. But to calculate the depreciation, just assume that if we follow the cost model, so then we have to look into that. The all these factors, okay, the cost of purchase, then the life, and then the before first tax period. So then we can calculate the tax return on value. Now the opening value, tax return on value and the opening value is both are same that we seen in the previous example. This is the opening value. For the tax purpose, at this is the 800. In our books is not shown. In books is shown the property value is a different, right? That is the fair value. But here is shown the 8. We calculated that. How is calculated? So we said its value is 1 million minus 200. So this is the 800, right? The property is disposed of. Now they think property is disposed of on April 26. This we can say the 1 year, 1.25 years. This is the 1 quarter, right? For 2 million. Much for the 2 million. The table illustrates the tax treatment under the depreciation election regime. Election, again, we opt and we may not opt. Let's see, this is the what we said, okay. In the scenario we taken, okay, up to 1st January 2025, the tax return on value is already given by here. How come up that we also understand. Now we said the basis for tax depreciation 4% of original cost are tax written down value. 4% of original cost is 40,000, right? So we are assuming that at the first year it both are same. Why? Because if we take the tax written down value, we already calculated is here. We already connected actually. So the lower of original costs are tax written down value. Here is the or. This is the first, this is the second, and normally the 4% of the original cost will take in. So now, as per Ministerial Decision 173, we deducted this depreciation. We deducted tax depreciation. Prorated full year, because for 25 is complete year. This is the full tax return on value. We minus then the balance value. So if we 800 minus 40,000, this is the balance, right? 800 minus 40,000. Aggregated depreciation claim to date. Okay. Tax depreciation, how much is claimed? 40,000. Recapture on realization basis. No. The next from April till from Jan 26 till April. So tax return on value is the same. We calculate here. This is the closing value. This is the it's mentioned already closing value. This will be the opening of next year. So this is the opening of. Then again the same formula, 4% of 1,040,000 pro rata basis. The pro rata basis because this period is not full, only 3 months, 1 quarter. So that depreciation is 10,000. Prorated. Yes, we can see this is only for 3 months. So now the depreciation tax return on value is 750. Why? Because 10,000 depreciation. Aggregate value claimed 50,000. Now the disposal, because we calculate the depreciation, now we're saying the disposal at 2 million. Here, the 2 million, right? So what is the treatment on disposal? We will say the aggregated value so far, this much. The 50,000 added back to the taxable income will be the plus in the year of sale. This is the minus before sale every year, this tax depreciation. But the same amount of depreciation that calls the tax depreciation, we have to keep the record. And when in the year of sale, we have to add into the profit and loss. So this is the under the realization basis when we opt. Now, let's see another example just to understand this. A real estate enterprises prepare a IFRS using a fair value model. Elected Article 20 for the realization based taxation is on proper building which purchased by them on the 21st July for 10 million. Calculate the opening value of the investment, proposition for tax purpose, depreciation charge, and tax return on value. So the first tax period is, as we understand for this, the CN is the applicable from the 1st January 2025 and thereafter. So if the property is purchased in July, so till this period, from July till 1st Jan 2025, what is the period? We can say this is 6 months for 2022. Sorry, 2021. 6 months, 22 is full, 23 is a full, 24 is a full. 1, 2, 3, so say 6 months. We can say 3.6. Okay, this is the period. So 3.5. The calendar year before that. Now the opening value we've seen 10,000, 4% of the this 10,000 multiplied 3. and balance opening value is this. This is the depreciation is calculated. Hope you understand, or we can do this again. The 10 million. So 10 million into 4%, how much? How much will be? Is 400 multiply 3.5. So just calculate how much it will be. 1.4 million something. All right. So this is the balance. We calculated the opening value. Now the depreciation, 4% is the 400,000. Okay. Tax written down value at the start of period is this. Okay. This is the greater than 4th. So what is the ministerial decision is saying? Lower of. So we'll take the 4%. If tax were filed, the return without making election, no depreciation claimed in the subsequent period. Now here, without election, if no election, then we cannot claim the depreciation in the 28. On the same parameter, this example is the continue. Okay, the small business relief, again, we're going to test over here and see. Any question before moving to this? I appreciate if any question. Yes, Amish. So far, the main topic or the main concept, do you understand or no? I can summarize one more time before starting our Excel working. If any questions, so please let me. Okay. Small business relief. Why we are looking for small business relief? Because if the person is already opted for small business relief, so he may not able to elect the ministerial decision fair value properties. Dar Limited acquired a property in 1st Jan 2024 for the 15 million. The first point, the acquisition date. Okay, what is that? 1st Jan 2024. So at 15 million. So this is the cost. So this is the first point that we require while applying the Ministerial Decision 173. So now they said is elected Article 21, small business relief. Okay. So now the next is the SBR. 2024, yes. This is they applied. Then 25 also they applied. Then 26 is also applied. So this 3 years, they applied the calculation. The perspective of this, how many years we can claim this, what is our learning, what we are focusing to learn after when we can say the 1st January 2025, the Ministerial Decision 173 tax depreciation, how many years we can continue. This is our point to learn over here. If the property is purchased before first tax period, as previous example, if I'm gonna go over here, just take this example. So here the 5 year before, right? Again, I'm gonna highlight over here the 5 year because concept is very important. If the property is purchased as this stage, right? They already mentioned 5 calendar years held before the first tax period. So what is the total life? The total life is not mentioned over here. So let's assume that if they given the 10 years, So 5 years they already utilized before first tax periods. So the same property we can continue another 5 years after the first tax period. After the first tax period, so this is called the thing, the tax depreciation. Next 5 years we can continue. This is our learning that we are focusing. Here, this one, 15 million elected the small business relief for 24, 25, 26. Is exit SBR in 2027. Now the first tax period after the SBR is 2027, becomes subject to corporate tax for the first time, right? As you know, when we are opting for the SBR, the full return is not calculated. 2 or 3 elections that we opted and then return will be closed. So in that case, the tax authority is saying when your first tax return as a full tax return is you're gonna submit, then you can opt for that. Then you still opt for that, because in 2025, if you opt, it will be irrevocable, you cannot go back. But if the taxable person is opting the SBR, then he is not filing the return. Of course, he cannot make this election. Okay. So this is the limitation, and this is the point we are learning over here. Under the article, the CN of 170, the opening value is the original cost each Gregorian calendar year during which the taxable person held investment property prior to the first tax period. Tax is imposed on the taxable person has previously elected for Article 21. Aldar held the property during 26 all the year prior to this, when the corporate tax first is imposed. The opening value must be reduced for each of 3 years. Opening value must be reduced each of 3 years. Original cost 15 million, reduction 3 years, multiply 4%. Okay, so this is 1.8 million. So these 3 years, because we didn't calculate or applied the Ministerial Decision 173, so is the same fashion what we are doing the calculation, or we are doing the before first tax period. We are calculating the depreciation and minus to arrive at the opening value, that is the tax return on value. So we are saying the opening value and tax return on value both are same. Why? For understanding or for calculation, we learned that the tax return on value means the original cost minus the number of years. So that is called the closing balance of the before first tax period or the opening of the first tax period, and that is the same of the tax return on value. So now this property is purchased actually the January 2024, right? In the previous example, what was our learning? Because property was purchased before first tax period, so we calculated that. Now the question is coming, so if the property is purchased before first tax period, that okay, we are calculating the depreciation. The tax is effective from January 2024 as the first tax period for the A Limited, right? So we will calculate the before that up to this, yes, but in this case, they opt for the SBR, right? So now, considering this property, considering this asset, immovable asset, their first tax period of that property, is 2027. So while reaching on this 27, so we have to do the calculation till this December 26, till December 26 to calculate tax return on value. Although if we go as this previous concept, as the general concept, our tax is already started over here, but we are opting the SBR. So even one of the another point where we previously said, okay, if the taxable person have the SBR, so the interest limitation rule, interest capping rule, so is they can still carry forward for the 10-year started or counting from the total minus excluding the number of years in which they calculate the SBR, in which they applied the SBR. Let's say you have the carry forward interest in the 2024. You file the full return, even you are eligible for the SBR, your revenue is less than 3 million, but you file the full return and you have unutilized interest due to limitation rule. Okay, in 25 we applied the SBR, 26 applied the SBR. Okay, now the interest limitation rule saying, okay, carry forward this next 10 years, which means 25 is gone, 26 is gone, balance 8 years. No, law is saying it will remain 10 years. This 2 year of the SBR will not be counted while this threshold of 10 years. Okay, now the depreciation, the 4%, we understand that. Anyhow, we will calculate. I think the concept we understand very precisely over here. The concept of today's topic we understand very precisely. Now we're gonna start our Excel learning and the computation with scenario based. So I'm gonna share you the Excel file. So please open that file.